Okay, on to part two. So we were in the middle talking about investment tools. Your first tool that we learned was bonds. The second was stocks. We discussed stock returns, then real estate, and now on to speculative investments. Speculative investments are very high risk investments. They have the potential for significant fluctuation, which fluctuation just means change, in return over a short period of time. Because speculative investments are such a high risk, they are only recommended for investors with an aggressive investment philosophy and high level of financial security. Well, that's just a fancy way of saying these are recommended for people who have money to play with and that they like to gamble on big amounts of money because there is a chance for high loss, but then also could be high gain. Three examples here are futures, options, and collectibles. Futures market is like an auction market in which participants buy and sell commodities or future contracts for delivery on a specific date. So an example might be wheat or cattle. So this is some type of market where you have a future contract. It has to grow or whatever, and then the delivery will come later. There's also options, contract to buy or sell a financial asset at a specific point in the future at a specified price. So, an example of an optional would be like real estate. Collectibles, cultural artifacts that have value because of their beauty, age, scarcity, or popularity, such as antiques, stamps, and etc. I'm not sure how much you know about antiques, but there are definitely some antiques that are worth a lot of money. So, the type of return on these items depends on the investment and what is used here, but they are definitely very high risk items. The last one we're going to discuss is mutual funds. Mutual funds is when a company combines the funds of many different investors and then invests that money in a diversified portfolio of stocks and bonds. So, in other words, you've got a company that combines a bunch of people's funds. So, like if we all own different funds in one particular company, then we are all a investor of that company. So when we're giving them money to invest and to use, and then we in turn get a return. What is included? You got bonds, stocks, real estate, and speculative investments. And then the types of returns that can happen is your interest, dividends, rents, and capital gains. And remember, you probably are going to need to go back and review. I'm not going to review them again because of sake of time, but you need to go back and review that you know what all four of these words mean. Okay, then you've got advantages of mutual funds. Your advantages of mutual funds is to reduce investment risk and it saves investors time, whereas in a disadvantage is fees may be high. Mutual funds are popular because they reduce the amount of investment risk by spreading among a variety of investments. Investors are saved time because time is not spent choosing individual investments. Instead, a group of mutual fund managers constantly evaluate the investments to buy and sell. So there's somebody monitoring that all the time. They work with the investors to manage their portfolio. Because mutual fund managers guide investors, fees are charged. So, like for example, I have a person that manages my mutual fund. I really know nothing about what's going on in my mutual fund, um, but my financial advisor, he looks at that type of thing. He sees what's going on with the company and if it's going up and down. And if he sees a situation where it needs to be sold, then he'll call us and say, I see a situation. I think you should sell it. You should switch companies. Then I will give him permission to do so. And most of the time, I just trust him to do that because of the fact that he knows what he's doing way more than me. This next visual has a very good demonstration of a girl who has $150 to invest. If she invests in option 1, which is a stock, as you can see up at the top, she has multiple options to invest with companies A through G. In this option with the stock, if she chooses to invest all of her money in company C stock, for example, so we've got C here, and Ariana invests in one company's stock, then if company C has a bad year and their market price drops, she loses all $150 of her investment. So that is one bad thing about having a stock, because if you invest it all here, then you can lose it all. Okay, but then at the same time, if she does well, that $150 increases more. Then you've got option 2, where same deal, she has $150, but she's going to put it in a mutual fund instead of a stock. So she's going to put it all the way around this time. The market price of companies C and F decrease. So let's say she puts it in every single one, and C and F are the only two that decrease. Then the market price increased for all other companies. So that means she has reduced her investment risk and may still earn money. So she's kind of put several eggs in several baskets so that she has a little bit more to gamble with. So she can actually make some money on A, B, D, E, and G and lose money only on C and F. The next concept we need to talk about is index funds. The stocks and bonds that make up a mutual fund are chosen by fund managers. The stocks and bonds that make up an index fund are based upon a particular index. So the type of mutual fund designed to reduce fees by investing in the stocks and bonds that make up the index. An index is a group of similar stocks and bonds. Some examples are the Standard and Poor's 500. So to try to put this in a nutshell, when you have an index fund, it automatically reads the index, which is the similar stock and bonds of what's happening at the time. So it tries to replicate the Standard and the Poor's 500, trying to match that, versus if you have a mutual fund, you have a group of professionals pulling your money in and out. Instead of doing an automatic reading, they're trying to beat the Standard and the Poor's 500. Take a minute and watch this video here below. What you'll need to do is copy and paste this link into YouTube. He does a really good job of explaining the difference between mutual and index funds. Definitely worth you watching. Don't skip this part because this can be very confusing if you don't have different ways of explaining it. Again, I'm not going to hit this so that you can watch it here because it takes up my video time, but if you can copy and paste it into your YouTube, that would be perfect. Okay, the next thing is lending versus owning. When investing, consumers either lend money to the company or organization, or they own the asset. So the company is either going to lend out the money so that you can borrow it, or they're going to own it. Some examples: lending is bonds, and the return is going to be the interest. Owning, examples would be you owning the stock or owning the real estate or the speculative investment. And then what the return's going to be is the dividends, the rent, the capital gains. So when you lend and you have the bonds, then this could be regular interest like you're used to hearing about. But if you're owning, like to put it in an easy way, you got real estate, you're going to get the rent from the person that's paying you because of the real estate. Hopefully that makes sense. Next, you see something that's kind of helping you to understand, if you understand the general risk of how this could affect you, it's going to help you to manage your risk better. By understanding the risk associated with an investment, the uncertainty of that risk can be better managed. Typically, if an individual owns an asset, the potential for higher returns, such as capital gains, however, the trade off is higher investment risk. So, if I own something, that's a good thing. I may get increased for higher returns, but it's also going to be an increased investment risk, so I have more to lose. Some investments have multiple types of returns. You can get any type of returns coming in these different directions. Therefore, within a particular investment tool, the risk level may vary. The type of return for a speculative investment depends on the investment. While speculative investments have the potential for high returns, they are extremely risky. So here, when you're talking about interest and you don't completely own it, you've got decreased inflation risk and you've got decreased risk all around, but you're not going to make as much money. Here, going to make more money, you're going to get more returns, but the risk there is very, very high. Characteristics of investment tools. Here, what I want you to do is take a second and pause the video and see if you can put in order these 4 cards like they were supposed to be cards, but we're just going to kind of play it mentally. Put it in order from lowest to highest in the risk range. So which one of these is the lowest in the investment risk range? The answer for lowest risk is your bonds, and the return is a fixed interest rate. Remember us learning that? We also learned that fixed means the same amount each time, so that was like us getting $50 every single year and it not varying. The medium risk is the stocks and the real estate, the mutual funds, and the index funds. The exact risk level varies depending on the type of investment. Mutual funds and index funds are typically lower because they include multiple investment tools. And then your highest risk would be speculative investments, and the returns will vary. If we were putting these in lowest to highest order as far as returns, it would be in that exact same order, because higher risk typically means the potential for higher returns. So that's something you need to think about. You may get higher returns, but you're also going to have higher risk. So the order is descending here, bonds on up. Okay? If I was to put these in order from inflation risk, remember we talked about that inflation is prices being driven up by economy typically. Which order would it be in then? The bonds are going to have the highest inflation risk because their potential for returns is the lowest, and therefore there is a greater chance their rate of return will not be higher than inflation. So it would go in reverse order here. Everyone has a different tolerance level for the amount of risk that they're willing to take on. The potential for higher returns often motivate people to take on the higher level of risk. An individual's personality will often influence their investment philosophy. The different categories is conservative, moderate, and aggressive. An example of this would be a person with 30 years until retirement may have a more aggressive philosophy than someone who needs to access their retirement funds in 5 years and should be more conservative. So it depends on your time. Aggressive here would be more daring, whereas conservative would be more careful with their investments. Here, if you're an aggressive investor, what types of investment tools would you use? It would be speculative investments, real estate, and stocks.